All right, Scott writes in, he's, I think, a couple years outside, maybe 2 years outside retirement. And he's worried about a bear market, so he's looking at Wellington or Wellesley. All right, and he writes a good question. He goes, look, I'm 2 years out from retirement, and I'm considering investing in one of these funds, Wellington or Wellesley. I'm worried about a bear market, and rightly so, I agree. And so what would you say with Wellesley? His concern, though, is that Wellesley might be a little bit too conservative, because remember, it's the Wellesley Income Fund, i.e. they're trying to generate income with heavy dividend stocks and lots of bonds. So Wellesley Income Fund is about 35% stocks, 65 or so percent bonds. So it's definitely heavy on the bond side. So because I like it, because it's less risky, but I'm worried about it might be too conservative. Look, here's the way I would do this, Scott. And this is just me. I don't know you from Adam. I'm just telling you the way I would do it is I would say, if you're worried about a bear market, and I don't know what your financial situation is, I have no idea. Why don't you just dump it all in Wellesley, all right? And then as each year progresses, move more over to the Wellington. So you know for a fact, you'll say, I have, I'll just use $100,000 for simplicity. I'll put in the Wellesley. That way it'll give me a lot more protection on the downside, for sure. As we know, Wellesley, if you look historically, has done incredibly well in the down markets. But you won't get a 30% return. In fact, I have no clue what Wellesley did last year, but we shall see as I do my projections or historical numbers on Wellington and Wellesley. All right, but we know that it didn't give you 30%. We know that for a fact, all right? So, but to be perfectly honest, so the bonds did quite well last year, so it might have done pretty well. It's not sustainable, but it might have done okay. All right, so anyway, what you say is, all right, I got my $100,000. I'll dump it all in Wellesley. All right, I know I'll capture some of the upside without a lot of the downside risk. Each year that goes by that I didn't get clobbered, I'll move some or whatever happens, but you probably won't get clobbered in Wellesley. I can't guarantee you that. So each year that goes by that you're not getting clobbered, you just move more over to Wellington. So you say, okay, I'll move, I got $100,000 in Wellesley. Next year, whatever happens to the stock market, I take 20%, 25% off the table and move into Wellington. All right, so that kind of helps you avoid the sequence of return risks. Still having some exposure to stocks, but having a strategy in which to get back in more aggressive, like the Wellington. Because remember, the Wellington fund was down roughly 35% from October 2007 to March 9th of 2009. So even though the Wellington didn't get hit like the S&P 500 did, 55% in that time, it got hit, man. That's more than a third of your capital. And you probably can't afford that. So I know I could have. So, start with the Wellesley, avoid some sequence of return risks, and then move it over systematically into the Wellington. Hey, hope this helps.